When tariffs hit, some companies don't just dip, they crater. Here's exactly which ones get destroyed first in Q1 Q2 2025 and why timing matters for your portfolio. Welcome back to Market Pulse Desk. Over the next 10 minutes, we're breaking down the tariff implementation timeline, analyzing which sectors and stocks face the fastest damage, and walking through real supply chain data to show you exactly where the pain hits hardest. Let's start with the timeline. Tariff announcements create a unique market shock because they don't happen instantly. Research from Trade Policy Analysis shows that tariff implementation typically follows a three-phase pattern. Phase 1. Announcement to implementation lag, usually 30 to 90 days. Phase 2. Real-world supply chain adjustment, where companies scramble to reroute inventory, front-load shipments, or renegotiate contracts. Phase 3. Earnings degradation, where margin compression and demand destruction show up in actual reported numbers. The critical window for Q1 Q2 2025 is this. If major tariffs are announced in late 2024 or early 2025, companies have roughly 60 to 90 days to absorb or pass through those costs. But here's the problem data indicates. Most companies cannot immediately raise prices by the full tariff rate without losing market share. Studies analyzing the 2018 U.S. tariff cycle show that companies typically absorb 40 to 60% of tariff costs in the first quarter, meaning earnings get hit hard before price increases can take effect. So which sectors get destroyed first? Let's rank them by vulnerability, starting with the worst. **** Rank 1. Apparel and footwear retail ****. This is the hardest hit sector historically and the most vulnerable right now. Why? Because apparel has two structural weaknesses during tariff shocks. First, approximately 95% of U.S. apparel is imported primarily from Asia. When tariffs hit imported goods, there is no domestic alternative. The tariff applies to nearly everything these companies sell. Second, apparel operates on thin margins. BLS data on retail margins shows athletic and casual apparel brands typically operate at 35 to 50% gross margins. But after accounting for distribution, marketing, and overhead, net margins sit at 3 to 8%. A 25% tariff, which is plausible on Chinese imports, immediately eliminates all net profit if companies absorb even half the cost. Let's look at the 2018 tariff case study. When the U.S. implemented 25% tariffs on Chinese goods in September 2018, apparel companies faced immediate pressure. Major retailers reported in Q4 2018 earnings calls that they were front-loading inventory in late 2018 to beat tariffs, which worked temporarily. But by Q1 2019, the inventory was sold, costs were rising, and consumer demand was starting to weaken. Stock prices for major apparel retailers fell 35 to 45% from peak to trough over the following 6 months. Data indicates this pattern will repeat in 2025. Why? Because front-loading works only if you have cash and warehouse space. Post-pandemic, many retailers still carry elevated inventory levels, and supply chains are already stressed. There's nowhere to hide excess inventory this time. **** Rank 2. Consumer electronics and consumer discretionary goods ****. Electronics face a slightly different problem than apparel. Tariffs on semiconductors, circuit boards, and assembled devices typically run 10 to 25% depending on the product category. But here's what makes this brutal. Electronics retailers and manufacturers have much longer inventory cycles than apparel. When a TV or laptop is produced, it sits in inventory for 60 to 120 days before reaching retail shelves. What this means, tariffs announced in early 2025 will apply to goods that are already in the supply chain or in production. Companies cannot delay or cancel orders quickly. Federal Reserve surveys from 2018-2019 show that electronics inventory specifically took 12 to 18 weeks to clear during tariff shocks, and every single unit in that inventory sits at a tariff-adjusted cost. Consider this scenario. A laptop manufacturer with a bill of materials of $600 faces a 15% tariff on components and final assembly. That's a $1.90 cost increase on a device they are already selling for $899. If they absorb half the tariff, $45, that wipes out 75% of their profit on that unit. Studies analyzing 2018 tariff impacts show that major electronics manufacturers saw earnings forecasts revised down by 15 to 25% in the second quarter after tariff implementation. Research also shows consumer discretionary goods, furniture, appliances, sporting goods, face similar compression. Why? Because these are manufactured goods with long lead times, and most are produced in tariff-exposed countries. Demand destruction also hits these sectors faster than essentials, meaning companies cannot even rely on volume to offset margin loss. Rank 3. Industrial materials and components. This sector doesn't get as much attention as retail, but the damage is equally severe. Steel, aluminum, chemical components, and industrial parts all face tariffs, but the real damage is indirect. When tariffs hit raw materials, every manufacturer downstream gets squeezed. A company that uses imported steel faces higher input costs immediately, but a company that sells to those manufacturers faces delayed orders and renegotiation requests. Historical data from the 2018 tariff cycle shows that industrial component manufacturers experienced order cancellations and postponements starting 6 to 8 weeks after tariff implementation. BLS Producer Price Index data from 2018-2019 shows that industrial input costs rose 8 to 12% following tariff implementation, but manufacturers' selling prices rose only 3 to 5% in the first 2 quarters. This margin compression persists for 6 to 12 months until either tariffs are removed or customers accept higher prices. The price pass-through problem. Here's the critical insight that separates tariff damage from other economic shocks. Companies cannot immediately pass through tariff costs to consumers without destroying demand. Research analyzing 2018 tariff implementation shows the following price pass-through timeline. Weeks 1-4. Companies absorb tariffs or announce price increases with future implementation dates, 0 to 20% pass-through to consumers. Weeks 5-12. Retail price increases begin to show up in consumer prices. However, competitors also raise prices, so demand begins to shift and weaken, 20 to 40% pass-through. Months 3-6. Full price increases are in effect, but consumer demand has fallen. Sales volume typically declines 5 to 15%. Companies that relied on volume to offset margin loss see earnings guidance cuts, 40 to 70% pass-through. Month 6-12. If tariffs remain, consumer behavior shifts permanently. Private label and lower price alternatives capture market share. For vulnerable companies, this becomes existential, 60 to 80% pass-through, but at much lower volumes. What this means for Q1-Q2 2025. Companies announcing earnings in those quarters will face a scenario where they've already absorbed significant tariff costs. Price increases haven't taken effect yet or are just beginning, and consumer demand hasn't yet weakened, so they're stuck in the worst possible position. Guidance cuts and stock price declines typically cluster in Q2 earnings season, 12 to 16 weeks after tariff announcement. Sector rotation patterns. Historically, when tariff shocks or trade conflicts materialize, sector rotation follows a predictable pattern. Data from the 2018 tariff cycle shows that defensive sectors significantly outperformed. Utilities, for example, returned approximately 12% in 2019, while the S&P 500 returned 29%. But this masks sector variation. When we isolate tariff shock periods specifically, September 2018 to June 2019, utilities returned 18% while consumer discretionary returned -8%. The difference: utilities are domestic, have regulated pricing power, and benefit from economic uncertainty, defensive buying. Similarly, consumer staples and healthcare outperformed. These sectors have higher pass-through capability. Consumers don't cut back on food and medicine during trade shocks, and both are less tariff-exposed than discretionary goods. Data indicates this pattern will repeat in 2025. Expect utilities, staples, and healthcare to outperform. Expect consumer discretionary, industrials, and electronics to underperform in Q2-Q3 2025. Why this matters right now. The S&P 500 has historically returned approximately 10% nominal returns annually, or about 7% real returns adjusted for inflation, over the past 80 years. But tariff shocks create temporary volatility that can last 6 to 12 months, with peak declines in vulnerable sectors reaching 30 to 50%. Companies most at risk in Q1-Q2 2025 are those with high tariff exposure, 30% of goods from tariff-targeted countries, thin margins, 5 to 8% net margin, long inventory cycles, 8 weeks of inventory in the supply chain, limited pricing power, commodity-like competition, debt-heavy balance sheets, limited flexibility to absorb costs. Research shows these companies typically see stock declines of 25 to 45% from peak during tariff shock periods, while less exposed peers decline 5 to 15%. The companies that suffer least are those with domestic production or tariff-proof supply chains, strong pricing power, differentiated products, fortress balance sheets, subscription or recurring revenue models. Demand is sticky. Regulated utility or infrastructure characteristics markets are forward-looking, so the real damage in stock prices typically hits 4 to 8 weeks before tariff implementation, when it becomes clear that tariffs will actually happen. This means the window for anticipating damage is narrow but observable. The bottom line: tariff shocks create predictable patterns of sector rotation and earnings damage. Companies get destroyed in a specific sequence: apparel and retail first, then electronics and discretionary goods, then industrial margins compress. This isn't random. It follows the supply chain, margins, and pricing dynamics we've outlined. If tariffs hit in early 2025 as currently discussed, research indicates Q2 earnings season will show concentrated damage in vulnerable sectors. Investors who anticipate this rotation, moving defensively ahead of time,